Welcome to Breaking News to Trading Moves. Today, we're looking at a recent retail update. It gives us a pretty clear picture of current consumer spending habits.
Yeah, we've got material that gets into specialty retail and the market reaction that came after a pretty key profit outlook revision.
Right.
So our goal is pretty straightforward. Let's look at the central announcement, identify the different groups of companies affected.
The ones that benefited and the ones that didn't.
Exactly. And understand why they fall into either the beneficiary or the pressured column, all based on the information we have.
So the central story here is the Abercrombie and Fitch announcement. What exactly did they report?
Okay, so the core news is that Abercrombie and Fitch raised the bottom end of its profit forecast. And the context for this is strong demand. It's a signal that momentum is continuing, particularly within that premium casual wear segment.
So this single announcement immediately sets up reactions across the retail sector.
It does.
Let's group these reactions into two main segments, and we can start with the beneficiaries.
Sounds good.
So the material we have highlights three distinct groups of companies that benefited from this news. Let's start with the immediate ones, the specialty apparel retailers.
Right. This group gains because the announcement basically validates strong demand trends and maybe more importantly, improving margins specifically in these premium lifestyle brands.
So who are we talking about here?
Well, of course, there's Abercrombie and Fitch's that's ticker ANF.
ANF.
Yep. And then you have American Eagle Outfitters.
AEO.
AEO, right. And also Urban Outfitters.
URBN.
Exactly. They all kind of play in that same sandbox.
Okay, moving on from there, we also see a positive reaction among teen and young adult retailers. Why is that group getting a lift?
Well, this points to continued brand strength with younger consumers. It's really evidence of resilient discretionary spending in that demographic.
So the thinking is, if they're spending at Abercrombie, they're probably spending at similar stores too.
That's the idea. It suggests that whole demographic is, for now, still spending on apparel they want.
And which companies are in that group?
Here we're looking at Gap, ticker GPS.
GPS.
And also Buckle, which is ticker BKE.
Okay. Now, the final group of beneficiaries isn't customer-facing retail, but it's the businesses further up the supply chain, the apparel makers and suppliers.
Yeah, and this is a logical outcome. When demand is strong at the retail level, it translates pretty directly into more wholesale orders.
Which is good for the companies that actually make the clothes.
Absolutely. It benefits anyone tied to apparel production.
So who are we talking about there?
The main ones mentioned are VF Corp, that's VFC.
VFC.
And Hanes Brands, ticker HBI.
All right, so now let's look at the other side of the ledger. Where are consumers pulling back spending, causing pressure for other retailers? The first category listed is value retailers.
This is the trade-off, right? The takeaway here is that consumers appear to be shifting their spending habits toward higher quality apparel.
Spending more on one thing means spending less somewhere else.
Precisely. This spending reallocation can reduce foot traffic and revenue at chains that are focused on lower budget categories.
Okay, so which companies are feeling that?
The materials point to Big Lots, ticker BIG.
BIG?
And Kohl's, ticker KSS.
Okay.
And Walmart is also mentioned, that's WMT. But it's important to note the impact is mostly on their apparel division.
Right, their overall business has that grocery and general merchandise buffer.
Exactly. But it's still a measurable effect, even for them.
Now, a second category feeling pressure is a bit surprising. It's mall-based and non-apparel retailers. Can you explain why success for ANF might be bad for, say, a jewelry store or a game seller in the same location?
It's all about the fight for the consumer's discretionary dollar.
The wallet share.
The wallet share, yeah. If strong apparel brands are attracting higher traffic and, more importantly, capturing more of that spending, there's simply less money left over for accessory shops and specialty stores that are nearby.
So people go to the mall to buy a new jacket, they spend a little more than they planned, and then they just go home.
That's the dynamic. The budget for that trip is used up. So that means less is available for the jewelry store or the game shop.
And who are the companies feeling that specific effect?
We're looking at names like Signet Jewelers, ticker SIG.
SIG.
And GameStop, ticker GME. If a shopper spends an extra $100 on a jacket, that's $100 not going to a new video game that day.
That makes sense. Okay, the final category under pressure are the e-commerce first apparel competitors. Now, why are the traditional brick-and-mortar brands gaining an edge over the online-only models here?
This really highlights the strength of what's called the omni-channel strategy.
Meaning having both physical stores and a good online presence.
Exactly. Brands with a strong physical presence combined with online capabilities are drawing customers away from players who rely just on an online model.
Why is that? Is it about returns?
That's a huge part of it. The ability to buy online, pick up in store, or to just easily return something in person without having to box it up. That's become a major factor for customers.
Especially with clothes, where fit is everything.
It's crucial. This omnichannel approach just satisfies the modern shopper's desire for convenience and immediacy a lot better than the online-only competitors can.
So which online specialists are feeling these particular headwinds?
The information points to Rent the Runway, ticker RENT,
RENT.
and also Stitch Fix, ticker SFIX. They both rely on a pure online or a subscription model, and they can struggle to compete on total convenience.
So if we put it all together,
Well, what the situation shows us is that consumer confidence in buying premium casual apparel is strong right now, and that momentum creates a clear chain reaction across different retail sectors.
right.
It favors the omni-channel specialists and their suppliers, while creating pressure on value brands and even those non-apparel stores.
It's a great final thought for you to consider. The movement of $1 into premium apparel doesn't just affect rival clothing stores, it pulls resources away from specialty stores in the same physical location. It's always important to trace where that consumer dollar lands next.
Thank you for joining us for this analysis.
And remember, this analysis is purely the opinion of the author of the material reviewed. It is not financial advice or a recommendation to buy or sell any security mentioned.
That's right, that includes Abercrombie and Fitch, A&F or Walmart, WMT, or any of the others.
We are simply reviewing the provided information.